Most people believe that if the money is in their bank account, they can access it whenever they want. After all, it's their money. They earned it, deposited it, and can see the balance every time they log in. But for a growing number of older Americans, the reality is more complicated than that. Across the country, retirees are discovering that withdrawing large amounts of their own cash isn't always as simple as walking into a bank and asking for it. If you're over the age of 60, or if you're helping an aging parent manage their finances, this directly affects you. And even if you've never experienced a problem at your bank before, the financial system has been quietly changing in ways that most people haven't noticed. These changes aren't always announced with headlines or explained in plain language. They appear gradually through new procedures, tighter security measures, fewer physical branches, and evolving fraud prevention policies. None of this necessarily means banks are trying to keep your money from you, but it does mean that many households are operating under assumptions that no longer match how modern banking actually works. Once you see the numbers clearly, you'll understand why this matters more than most people realize. The first thing to understand is that this isn't really about whether your money belongs to you. It does. The misunderstanding comes from confusing ownership with immediate access. Those are two different things. Over the past decade, banking has shifted dramatically toward digital transactions. Millions of Americans now pay bills electronically, transfer money instantly through mobile apps, and rarely carry physical cash. For younger households, that's simply become normal. But many retirees still prefer cash for everyday expenses, whether it's paying a local contractor, helping a grandchild buy a used car, making charitable donations, or simply feeling more comfortable managing a monthly budget with cash in hand. Physical currency remains an important part of daily life for many seniors. The problem is that the banking system has increasingly been designed around people who don't need much cash at all. Thousands of bank branches have closed across the United States over the past several years. Banks have invested heavily in digital services while reducing the size and operating the costs of many physical locations. Smaller branches often keep significantly less cash on site than they once did because customer demand has shifted toward electronic payments. That creates an unexpected situation. A customer may have $50,000 sitting safely in a checking account, but the local branch may not physically have that amount available in its vault on a random Tuesday afternoon. To someone who has banked the same way for 40 years, that can feel confusing, even alarming, but in many cases, it isn't about permission, it's about logistics. This is where many people begin to misunderstand what's actually happening. Let's look at the numbers. Most banks place daily ATM withdrawal limits somewhere between a few $100s and around $1,000, depending on the type of account and the customer's banking relationship. Those limits aren't usually established by federal law. They're typically internal policies designed to reduce losses if a debit card is stolen or compromised. For the average household making ordinary purchases, these limits rarely become an issue. But imagine you're a retiree who needs $4,000 in cash to purchase a used vehicle from a private seller. You check your account balance and see plenty of money available. You drive to the ATM, expecting a quick transaction. Instead, the machine stops after a few $100s. Nothing is wrong with your account. Your money hasn't disappeared. You've simply encountered a security limit that you may never have known existed. For many seniors, this is the first moment they realize that having money and accessing cash are not always the same thing, and that's only the first layer. Many people naturally assume they'll just walk inside the bank instead. After all, speaking to a teller should solve everything, right? Often it does, but not always. Modern branches are designed to meet typical daily customer demand, not every possible request. If someone unexpectedly asks to withdraw several $1,000s in cash, the branch may simply need time to order additional currency from its cash supplier. Again, that isn't necessarily a refusal, it's preparation. Unfortunately, when no one explains that difference clearly, Customers often leave believing something is wrong with their account or that the bank doesn't want to release their own the money. That misunderstanding creates unnecessary stress, especially for older adults who have spent decades believing that walking into their local branch guaranteed immediate access to any amount they needed. Here's what makes this issue even more important. America's population is getting older. Every year, millions more people enter retirement. Many are managing larger retirement balances than previous generations, while simultaneously becoming primary targets for financial scams. Banks know this. Financial institutions have seen a sharp increase in fraud schemes targeting older adults. Criminals frequently convince victims to withdraw large amounts of cash under false pretenses, whether through fake government investigations, romance scams, emergency family requests, or fraudulent contractor payments. As a result, banks have strengthened fraud detection procedures. Employees may ask more questions than they did 20 years ago. They may encourage customers to slow down before completing unusually large cash withdrawals. They may verify identification more carefully or ask about the purpose of the transaction. To some customers, these questions feel intrusive, but from the bank's perspective, they can also prevent devastating financial losses. This creates an important balance. Banks are trying to protect customers from fraud while also respecting their right to access their own money. Most of the time, those two goals work together. Sometimes they create friction, and this is where almost no one talks about the real issue. The biggest obstacle usually isn't the bank itself. It's the lack of communication before the withdrawal ever begins. Many problems can be avoided simply by contacting the bank in advance, explaining how much cash will be needed, when it will be needed, and which branch the customer plans to visit. That single conversation gives the branch time to prepare the cash, verify account information, and ensure the withdrawal proceeds smoothly. Without that phone call, even a perfectly legitimate withdrawal can become an unnecessary inconvenience. The difference between a frustrating experience and an easy one is often just a few minutes of planning. But there is another financial rule that surprises even more people, and unlike ATM limits or branch cash availability, this one involves federal reporting requirements. It's completely legal, it's completely routine, yet it's also one of the most misunderstood parts of the American banking system. And this is exactly where many well-intentioned people accidentally make decisions that can create problems they never expected. Most people have heard that there's a $10,000 limit on cash withdrawals, but that's not actually what the rule says. This is where a lot of confusion begins. And, unfortunately, that confusion sometimes leads people to make decisions that create bigger problems than the withdrawal itself. If you withdraw more than $10,000 in cash from your own account, the bank is generally required to file what's known as a currency transaction report. For many people, the moment they hear the words government report, they immediately assume they've done something wrong. In reality, the report is simply part of the banking system's compliance process. It doesn't mean you've committed a crime. It doesn't freeze your account. It doesn't automatically trigger an investigation. It's simply documentation that financial institutions are legally required to submit for qualifying cash transactions. The misunderstanding begins when people try to avoid the report. Maybe a friend tells them, just take out $9,000 today and the rest tomorrow. Maybe someone at the coffee shop says, keep each withdrawal under the limit and nobody will notice. That advice sounds harmless. In fact, it sounds responsible. But this is where most people get caught. Federal law doesn't just look at the size of a withdrawal, it also looks at intent. Deliberately breaking one large cash withdrawal into several smaller withdrawals for the purpose of avoiding reporting requirements is known as structuring. And structuring can become a legal issue even when every dollar belongs to you and every dollar was earned legally. Think about how surprising that is. The problem isn't withdrawing your own money, the problem is intentionally changing how you withdraw it to avoid paperwork. For most households, the simplest path is also the safest one. If you need $12,000, for a legitimate purchase, ask for $12,000. Let the bank complete its reporting requirements. The paperwork costs you nothing, takes only a few moments, and allows the transaction to move forward normally. Ironically, the strategy many people believe protects them is often the one that creates unnecessary attention. But there is another issue that's becoming increasingly important, especially for retirees: financial scams. Over the last several years, criminals have become remarkably sophisticated. They no longer rely only on suspicious emails or poorly written text messages. Many scams now involve convincing phone calls, fake government agencies, artificial intelligence voice cloning, fraudulent investment opportunities, or emotional stories involving family emergencies. Older Americans are frequently targeted because scammers assume they have accumulated savings and may be less familiar with rapidly changing technology. Banks know these patterns. Tellers know these patterns. Fraud investigators know these patterns. So when an older customer suddenly requests $15,000 in cash and appears nervous, distracted, or unwilling to explain why they need it, bank employees often pause the transaction long enough to ask a few questions. To the customer, those questions can feel uncomfortable, but from the employee's perspective, they've likely seen situations where those few extra minutes prevented someone from losing their life savings. This is why understanding the why behind the questions matters. The goal isn't to make banking harder. The goal is to make financial exploitation more difficult. Now, let's step back for a moment, because this is where two very different financial paths begin to emerge. There are households that react to changes after they happen. Then there are households that prepare before they happen. The first group usually assumes everything will work exactly as it always has. They don't think about withdrawal limits until the ATM declines the transaction. They don't call the branch before requesting large amounts of cash. They aren't aware of reporting requirements until someone mentions them at the teller window. Every obstacle feels unexpected because they only learn the rules at the moment they need money. The second group approaches banking differently. They ask questions before there's a problem. They know their account limits. They understand how much notice their branch prefers for large cash withdrawal. They recognize when a cashier's check or electronic transfer might accomplish the same goal more safely than carrying thousands of dollars in an envelope. Those differences may seem small, but over time they create dramatically different experiences. One household experiences frustration, the other experiences confidence, and that difference extends far beyond banking. The same pattern appears in retirement planning. It appears in tax preparation. It appears in estate planning. It appears in investing. People who understand the rules before they need them almost always make calmer, better financial decisions. Now let's make this personal. If you're in your 30s or 40s, this may feel like a problem you'll deal with decades from now, but today's banking habits become tomorrow's financial habits. Learning how financial institutions operate now makes future transitions much smoother. If you're in your 50s and beginning to think seriously about retirement, this is an excellent time to review how you'll access your money once regular paychecks stop. Many retirees discover that managing withdrawals becomes just as important as building savings. If you're already retired, ask yourself one simple question. Do you know your bank's policies before you actually need your money? Could you confidently withdraw $5,000 next week if an emergency required it? Would you know who to call? Would your local branch have the cash available? Would another payment method work better? Those aren't questions most people ask during calm times, but they're exactly the questions that make stressful situations much easier to manage. Because financial security isn't measured only by how much money you've accumulated. It's also measured by how easily you can access that money when life demands it. And in today's financial system, understanding the process is becoming just as valuable as understanding your account balance. The biggest lesson in all of this isn't really about cash. It's about preparation. Financial confidence doesn't come from assuming the system works the way it did 20 or 30 years ago. It comes from understanding how it works today. The banking industry has changed. Technology has changed. Fraud has changed. Customer behavior, and whether we like those changes or not, learning to navigate them is far more productive than being surprised by them. So what can you actually do this week to make sure you're prepared? Start by calling your bank while nothing is wrong. Ask one simple question: what is my daily ATM withdrawal limit? It's surprising how many people have no idea what that number is until they're standing in front of a machine that won't dispense the cash they need. Knowing your limit costs nothing, takes only a few minutes, and removes one uncertainty from your financial life. Next, if you expect to need a significant amount of cash for a home repair, a vehicle purchase, or another legitimate expense, don't wait until the day of the transaction. Call your local branch ahead of time. Tell them approximately how much you'll need, when you'll need it, and where you'd like to pick it up. That simple conversation gives the branch time to prepare and dramatically reduces the chances of unnecessary delays. It's also worth asking yourself whether cash is truly the best option. Many large purchases can be completed using a cashier's check or another secure payment method. These options often provide better protection for both the buyer and the seller while eliminating many of the logistical challenges associated with carrying large amounts of currency. Another important step is to review your fraud protection settings. Make sure your phone number and email address are current. Enable account alerts if your bank offers them. These notifications can help you spot unusual activity quickly and provide another layer of security without adding much effort to your daily routine. If you're helping an aging parent manage finances, this is an excellent opportunity to have an honest conversation. Ask whether they know their bank's procedures. Ask whether they understand current fraud scams. Discuss who they would call if they needed a large withdrawal unexpectedly. These conversations may feel unnecessary today, but they can prevent confusion during stressful situations later. And if you're retired yourself, consider establishing a trusted contact with your financial institution if that option is available. A trusted contact doesn't gain control over your money. Instead, it provides the bank with someone they can reach if they ever believe you're the target of financial exploitation or if something about your account activity seems unusual. It's a small step that can provide meaningful protection. Perhaps the most important habit of all is this: don't let rumors become financial advice. Every community has someone who claims to know the shortcuts. Someone who says, just keep your withdrawals under a certain amount, or the bank can't ask you questions, or you should never tell them what the money is for. Financial decisions based on hearsay can become expensive very quickly. Instead, get information directly from your financial institution. Policies vary between banks. Procedures evolve over time. The most reliable answers will always come from the people responsible for your account. There's another perspective that's worth considering. For decades, financial success was often measured by how much money someone accumulated. While that's certainly important, retirement has a way of changing the equation. As people transition from earning income to using savings, access, flexibility, and planning become just as important as the size of the account itself. Think of retirement as a long journey rather than a single destination. Along that journey, you'll likely replace a roof, purchase a vehicle, help children or grandchildren manage healthcare expenses, travel, and respond to emergencies you can't predict today. None of those events are unusual. What's important is having a financial system that allows you to respond calmly when they happen. That's why the households that experience the least financial stress are rarely the ones who know every tax rule or every banking regulation. They're usually the ones who prepare before they need to act. They understand the systems around them. They ask questions early. They update their plans as circumstances change, and they avoid making emotional decisions during moments of urgency. Small habits create large advantages over time. A 5-minute phone call today can prevent hours of frustration next month. Reviewing your account policies once a year can eliminate confusion during an emergency. Learning how reporting rules work can help you avoid unnecessary mistakes while giving you greater confidence when accessing your own money. Financial security isn't built in one dramatic decision. It's built through dozens of ordinary decisions made consistently over many years. That's true whether you're just beginning your career, approaching retirement, or enjoying the retirement you've spent decades working toward. The goal isn't to fear the financial system, the goal is to understand it, because when you understand how it works, you make better decisions, you experience less stress, and you're far more likely to stay focused on what really matters, using your money to support the life you've worked so hard to build. So here's a question I'd love to hear your thoughts on. Have you ever gone to your bank expecting a simple transaction only to discover there was a rule or policy you didn't know about? If so, what happened, and what did you learn from the experience? Share your story in the comments. Your experience could help someone else avoid the same confusion. And if you enjoy calm, research-driven explanations that help you make smarter financial decisions without the fear or the hype, consider subscribing. Every week, we break down the financial rules, policy changes, and retirement strategies that quietly shape everyday life. So, you can stay informed, stay prepared, and move forward with confidence.